Okay. Pause that. Well, that's what our tech TA is here for. Keep us from making mistakes like that, but fortunately, you sharp guys out there in the audience caught it. Okay, so welcome again, Max. Max Lee made a special trip from New York to be with us this time, as well as for next week and the week after that. So it's a real honor to have Mr. Lee, who is a director at Bank of America. Now, these big houses are very sophisticated, actually, in what they do. As you read from the strategies report from J.P. Morgan, I mean, it's almost mind-boggling what those big houses do. So, but Max is a director of commodities and index trading teams at the Bank of America Securities. And he's also a lead trader. So he knows what he's talking about. And he's been working with Mr. Brandefine. He'll introduce Mr. Brandefine. But Brandefine is a broker at PVM Futures, which is basically an energy complex or oil futures. Maybe you can set me straight on that. And he's worked he's seen the pits at the exchanges. Oh, here is our director of our Center for Computational Engineering. This is Dr. Kathy Inser, and she came in from her time series conference just to sit on this class. So I've introduced Mr. Lee. Mr. Lee has been around here for about 10 years, started as an MSTAT student a couple of years ago as an undergrad. And he is director of Bank of America Securities, leading the commodity and foreign exchange systematic strategy and index trading team. He's a lead trader for creating alpha and beta indices, as well as developing discretionary relative value and hedging strategy for both intraday and interday. And Mr. Brandefine, who Max will introduce momentarily, has been in commodities since 1996. So Max, without taking any more of your time, let's hear about the evolution of asset classes.
Sure. Remote, or anyway. Well, hi guys. It's good to finally be here in person. I'm glad that you made the time down. So it's been a bit since I think last week or last month where we talked about sort of the risk premium and the structuring side with Kranti. So this week we're going to sort of take that and move a little bit into sort of like where that actually takes place from an asset class perspective. And so a little biased, we're starting commodities, which is where I started, and I think it's actually very apt time to sort of talk about it, and especially as you guys think about where the opportunities are for you, both either professionally, your own accounts. This is kind of a market that's really sort of blowing up right now. So let me see if I can just perfect. Okay, so we always try to start with a market of interest, and we're going to stay within the commodities asset classes given the week. So we talked about natural gas last week and what was going on. From that perspective, the rally has kind of abated a bit, but you still see prices in the UK and in Europe still at 300, 400% up year to date. And like I said, what's really interesting, I think, about the commodities asset class in particular is that that's a direct impact to the consumer, right? And it's an impact to you guys. And there's always these questions like, do you want to profit off some of the stuff that has real world impact, which is a different discussion. But when you think about the S&P is down 2%, how does that really impact your day to day? It doesn't really. I mean, your 401k maybe takes a little hit, and then you check again 20 years later, and you wouldn't have even remembered. So there's actually some real structural things that go on in the futures and the commodities world. So this particular chart I just grabbed from Bloomberg, this was actually last week. But so this is actually the spot in the inventory price for EUA carbon credits. The carbon market is one that has just recently, I'd say in the last kind of 2 years, really taken off with some of the ESG initiatives. Everyone cares about the environment. And the EU has a carbon trading sort of platform, which is probably one of the farthest along. So this is actually up, you see roughly, again, close up almost 100% year to date at one point. And I think that, if you think past 2020, right? So last year you see a lot of volatility in the stock market. You see some of these names on some of the retail side, being able to sort of help incite 100% rallies, 1,000% rallies in the stocks. But in reality, if you went further back, you don't really see that much in the equity market. So one of the things I want to sort of incite you is that in the commodity market, especially, volatility is much higher on a realized and implied basis. And so, part of that is in the sense that there's a liquidity aspect to it. It's much less traded. There's a lot fewer, there's a lot less money, so it becomes less efficient, or it is less efficient, which is better for trading. And there's some true issues that can occur. Like, again, going back to the idea of like, what is a share? Past the earnings releases, you don't really know what's going to dramatically really move Apple's price, the incremental 10% on a weekly basis. But if you get a fire or a frost, actually, like in Brazil, which happened about a month ago, the price of coffee there, which Brazil is one of the largest exporters of coffee to the world, the price of coffee shot up almost 25% in a week. And that's not an unusual occurrence, which is something I want to continue to stress, because again, if you want to make a career in trading and risk management, you get rewarded for volatility, right? And you don't necessarily want to be somewhere that implied vol is generally extremely low and your benchmark grinds 10 to 15% up every year. That's a very hard thing to beat. Just things to think about. So this is the carbon market. Like I said, it's a very interesting thing because there's a lot of people calling for this price to go to 100 within, the next year or so. And if you think about it, in theory, it should be a one-way market, right? Because it's effectively the price of every incremental metric ton of CO2 production in the EU. And given some of the carbon neutrality and sort of mandates, carbon in theory becomes more expensive. Like, there's really not supposed to be a natural seller per se outside of the speculative market. So anyway, so things to think about. I don't want to spend too much time on it, but this was our market of interest. So just from last time, and I'm just going to check make sure I see the time. I give Billy enough time. Just to review, we talked about risk premia again. So what was risk premia? That was the idea that you can trade markets on a somewhat mid to even, decently, on maybe even intraday basis, but mid-frequency, low-frequency trading that can actually deal with a decent amount of size, but it is effectively transparent rules-based risk. And, I think that gets bucketed somehow, a lot to the banks, but in reality, a lot of quant funds do effectively this. They have some sort of fundamental prior that they're starting with, and they evaluate a model, some robustness tests, and then deploy the risk in a way that can be recreated for clients, for investor purposes. So it's a very interesting thing because it's also replacing, I think, to some extent, the fund industry, right? As we say that each incremental percent return that you try to get from an active standpoint is getting harder. There again, it really isn't a way to or a reason to pay 2 and 20, which is 2% management, 20% of profits, when you can go to a bank, maybe make 5% less on a bad year and only pay 20 bips. So it's effectively, you can think of this somewhat as like the ETF space of the alpha world on the OTC market. In the sense that it's very cheap, much cheaper, and you can get access to the whole sell side platform. So Kranti talked to us about sort of some of the things he looks at. Again, if you have any questions for him, by all means, please shoot them to me and I can pass them along. He's a really smart guy, considered one of the industry best across the street. And he talks some ideas about robustness. Again, we didn't spend too much time in the nitty gritty, but if you have questions about how to avoid overfitting, if you want to get into that, I'm sure he would be happy to answer. But anyway, so that was last week. We won't spend too much time. We'll sort of go forward. So commodities. Effectively, the difference here is that this is representing some standardized unit of raw material that's used in economic production. So the things you really hear about tend to be more macro related. So you hear about oil, you hear about gold, maybe you heard about lumber this year as well. But in reality, there's actually quite a wider range of things, and they all mostly will trade on an exchange, at least the things that you'd probably be interested in. And there is a lot of diversification there. It's not just counting the bushels of corn in the Midwest, right? There's actually a lot of things that you see, and we'll go through some of the ways that people do it from like a quant trading side. But the asset class itself ends up being much more cyclical, right? You have to see inflation concerns, which commodities tend to be a very good hedge for, where people like to buy. In theory, their non-stockholder prices will sort of accompany that. You see a lot of hedging from producers and consumer side. So, again, thinking about where's the application of this class, I don't know where everyone wants to end up, but if you go to New York, there's plenty of opportunity. But if you want to stay here, oil is a massive industry. And if you want to sort of take some of that quant trading and you want to still be in finance, working at an oil company like Shell, which is one of Billy's major clients, work at BP, you want to go work for power trading, like that's all here. Houston is still one of the energy capitals that all relates to some of the commodity trading. So, these are some of the main things. And like I think the interesting point was maybe a week or last time was that, the ability to innovate here, I think from an underlying standpoint is very high. the next company gets listed on the New York Stock Exchange that has some tech offering. How exciting really is that? I don't know. I mean, it gets kind of folded into what is the equity market, but going back to even just on the carbon example, there's a lot of advents going on in sort of what kind of markets are being listed to trade under. So we talked about carbon, we talked about water a little bit ago, weather futures. These are all things that are starting to take shape that the exchanges are starting to offer. And that presents opportunities. Again, you want things that are easy enough to trade that you don't have to worry about dealing with ISDAs and trading OTC, but you also want them to be new enough that you can still add value, right? And that maybe there's some edge. So it's an interesting space, and these are some of the random things. So see the time. In the reading, I guess at its principle, commodities trade on a futures basis, right? And so if you ignore everything else about how do you differentiate strategies and how do you make monies in different ways in the market, at its core, there is a spot price for everything, right? Which reflects the current physical demand. And that's measured in a couple of ways. There's indices, like we saw for the carbon, that track the spot price. There's quotes sometimes in less liquid markets. But at the end of the day, you are trying to predict what you trade is going to be a future, or some derivation of it, right? You trade an option, the underlying portion of that is going to be a future. You trade a variance swap, it's still it's implied volatility, or trading realized volatility expectations, which again, at some point, are going to be the volatility of the future. What exactly is the future? It's effectively the forward price of something first, and then what makes it different from a forward is that it's on an exchange, so it's cleared. It's for a standardized amount, a quantity, and grade of some product. And what really drives it is that you're looking for how the spot price moves, as well as the cost of carry. And so, when we think cost of carry, usually you think of sort of like an equity competitive, think of interest rates and minus dividend yield. But actually, the cost of carry is very interesting in physical goods because it takes something to store a barrel of oil, right? And there are people that make careers off sort of estimating that difference and how that difference will change, and to some extent thinking about where the storage in the world, what is the rate or cost of having to get that product there. So like I said, there's a lot of components that go into it, but at the end of the day, this is kind of like the core diagram that everyone shows from a future standpoint and you never use ever again in your life if you actually come into the field. But it's a good representation, right? If you're always estimating future sort of equilibrium price between supply and demand, and how you do that can be a little different. And very relevantly timed, this is kind of like the list of things about what people trade at a very high level. So we said flat price, which is again just that pure futures play. It's traded on an exchange. You can be long only, which actually there's a lot of mandates for. Again, going back to that inflationary hedge where people diversify out their equity exposure, or relative value, and this is kind of like your total return vehicle. If you're in an investment, either you're at a bank, you're a trader at a bank, you're a trader, even at a producer, you're still trying to make money necessarily, or against some of that physical asset. Or if you're at a hedge fund, again, long short is the bread and butter. And the directionality of that trade is really like, where is flat price going on its own or relative to something else? And so the example is, you buy one lot of crude. And so if you remember, on the future side, everything has an exchange, it has a delivery component to it. And so you have contracts that you have to roll. And so the Z refers to the December contract. And so the version of this is you buy one lot of December crude. And so that is effectively saying, if you held it until delivery or expiry, you were buying one lot of, which is 1,000 barrels of WTI from Cushing for delivery at some date in November. And if you actually held it, you didn't roll it, you would have to go to Oklahoma, or someone would have to go to Oklahoma and find those 1,000 barrels, and you would need a big pool. But so that's kind of the baseline, again, the base unit of exposure. And then from there, you get all this increased complexity. So staying within the linear side, you have calendar structure, which is a very big component of commodities trading, which really isn't so much in equities, right? You have a difference between the value of something, the same spot price, you're removing that component of return and looking for the difference between where the front of the curve, which is the nearer term supply, where the nearer term price is going to expire versus a deferred price. And so this is very much reflective of sort of supply and demand. The idea of this is where you hear the curve plays come into account. And so, a market that has a lot of upfront demand where, consumers are pulling it out of the ground, maybe if it's gas or oil, like for example, winter's coming, right? A lot of times you see the front of the natural gas curve rally quite strongly versus the back, because in the back you're looking towards less, or you have more time to recoup supply. You're moving to a warmer part of the year, which would be, summer of 2022, versus potentially very cold shocks in the upfront, which has some uncertainty. And so you see that's what we call backwardation, where effectively the front of the curve is more expensive than the back. or if conversely contango, where it's the reverse. And so these kinds of structures these type of derivatives are actually much more appealing in some ways to a quant side because it's more modelable from a statistical format that has better mean reverting properties and it has a true, like I said, relationship to the market. Whereas if you look at the flat price futures, you see a lot of spec money that are able to sort of influence price, or you get a lot of macro headlines, right? That you could see, for example, crude be down, $3 just because the world is worried about equities, but the structure is actually maybe unchanged on the day. And so it provides actually a decent way or decent vehicle of taking risk that is generally a little higher liquid or a little better liquidity in the sense that you don't see these gaps. And if you get really into the nitty gritty of how do you fund these positions, it's better from a margin standpoint as well because it's effectively long something, short something that have very good correlation. Excuse me? Yes, this is how the carry premium would be implemented, right? You would effectively be short the front and long the back on a rolling basis in the commodity world. So it's a lot of words, I know. Trying to move through it. But anyway, so that's kind of like the summary of the main linear exposures. So then you get to the whole nonlinear world, right? And this is where you introduce sort of convexity by taking or effectively trading optionality. And so you have your vanilla structures, which is your calls, your puts, your call spreads, your risk reversals, all the way up until your exotics. And this would be effectively, trading I think the example was a one-touch, which is kind of like a digi knockout on ecom at a certain level. And it may not mean a lot to you, which is fine, but the whole point is that, I think a lot of times the media sometimes portrays certain asset classes that aren't equities or maybe not even like credit rates, not the sexiest per se, but there's a lot of ways to make money in something like commodities as well. And these structures are present, in equities or present in FX and in mostly similar formats. But again, you want to think about where's the volatility. And honestly, I think the commodities asset class is one of the highest. So if anyone has any questions, I'm going to move on. But if anyone wants to talk about this, like I said, I'll be here for the next 2 weeks. We can more than do that. So in the next 5 minutes, I'll just kind of try and run through this. One of the things that we kind of had hoped to talk about a little bit is why, the world passed equities, right? You hear that a lot on, in research, most things are equity oriented, just given the prevalence of the data. It's very easy to obtain. You look at media, it's very equity heavy as well, and movies, books, whatever. So, what makes this different and why is it, I think, an opportunity is something that we've been trying to talk about from the FICC sense, sort of past that asset class. So I think, if we think there's kind of 5 main things really that we could sort of talk about at a high level. Deliverability standpoint is that the idea that, again, you have to roll the futures. Because most people, if you're financial, you don't want that 40,000 pounds of live cattle delivered. So that actually creates a lot of opportunity because now you have a sort of forced flow of the financial money, which actually presents, ways of backtest or opportunities to backtest, trades that you can try and, pre-position for expected flow. I think the most sort of clear example of this was the oil market on April 20th, right? I don't know if anyone remembers last year, but the world was ending already from COVID, and then all of a sudden, we have the OPEC war, so now oils went from, came in at like 60, maybe 20 at the beginning of the year. We're now down to 20. You come down to the day before expiry for the May WTI contract, which again, the main oil contract for the US, and we dropped $50 into like negative 37. And so what that means is that you could have driven to Oklahoma, and if you had bought that, they would have paid you $37,000 per contract to give you the oil. So again, if you had the pool, it was a great time. But after some of the dust has settled, where it comes out is that part of what contributed to it is there was this massive investment vehicle in the Bank of China that effectively had this very large position that for whatever reason they didn't roll per se. And then when we think about for our books, we have to be out. We're out of the front contract very early on. We don't want to get anywhere near expiry. There are limits from an exchange perspective what you can carry sort of up into these periods. For some reason, and again, the details are not exactly clear. There's mass position. There's no liquidity as you go into that because again, if you think about who is trading, to have liquidity, you need someone that's willing to take the other side, right? And again, given the deliverability of these contracts, there's no one really there except for maybe some small funds that are looking to do some algorithmic things, potentially, again, in very small size. So if you have to unload 10,000, 20,000, however many lots, 2 days before the contract actually expires, and again, physical delivery is a very big thing because you have to actually come and take it. There are a couple of commodities that are cash settled, and that presents its own opportunity because again, if it's cash settled, this is like NDF trading in the FX world. you don't really have to worry about it taking that foreign unit of actual goods. So that presents its own issues or its own opportunities. But for crude, WTI especially, it's physically delivered, you can't take it, so the market just, got absolutely smoked. And then, you run into algorithms, again, trying to profit, the market gaps, and, we end up at minus 37, which again, does not make really economic sense.
So what happens if you just absolutely don't take it and you don't do it? You go to jail?
Yeah, you can't not take it. It will show up, it will effectively, you'll be your obligation. They may store it for you and you just have to start paying it, and then it becomes, assumedly a financial crime. It's not something that I've ever really paid attention to because I feel like my managers would not be happy, but it is an issue. I mean, even to give you a sense, we are one of the largest on the street from an index standpoint, AUM north of 35 billion. And effectively, whenever we're in a delivery period, if we have one lot, so it's literally, that's a very fractional, it could be $20,000 worth of notional effectively. One lot comes on because, someone just accidentally clicked something, immediately alerts go off all over the place. I get calls from Chicago teams that manage our clearing, get calls from compliance teams here in Houston that are monitoring it as well. So it's a big deal. And, like I said, the whole point of why it matters is because it does provide an opportunity, right? Because this is something that structurally is going to happen in the market. So tracking open interest, tracking volumes, these are all interesting things that provide ways to generate alpha. We sort of talked on term structure, market structure we kind of skip. The participants thing is actually very interesting because again, you want to think about who, trading generally is kind of a zero-sum game, who else is there? And when you think about, again, the equity market, it's a very interesting that, you have a lot of retail money, a lot of fund money that's kind of long only. These people are managing investments. Everyone expects equities to go up versus the commodity market. Again, it's kind of a very cyclical thing. Your benchmark, you could roughly say zero to actually generally negative. I mean, commodities have been in a bear market for a while, outside of now. And so you have a lot of players. You have, producers who actually, generate the oil, grow the corn. They have their own set of information. You have, and they're, again, naturally long, so they're pretty much going to be short the market, right? They're looking in the financial market as it impacts them. They're looking to hedge production versus consumers. You have your airlines, right? You have people that, your t-shirt factories that buy cotton. They're naturally short the input. And then you have, large financial players like indices, which is kind of like us, where, maybe not in the sense of like the oil market, but you do get the sense of like, in some of the less liquid markets, that actually ends up being a substantial portion of the OI that is in those futures markets. So you get, I think, a much bigger blend of like who is actively trading and what direction they're going versus equities where everyone generally is long, and then at the idiosyncratic level, maybe people are short specific stocks. And even when people do come in, like last year, to be kind of short the market, it's on very, very concentrated I would say short spurts generally. You don't have anyone that's generally just always going to be bearish the equity market for 10 years. Whereas you do have people that are naturally long, so they're always going to be selling corn. So that's an interesting opportunity. It creates an interesting opportunity, again, I think, in the sense that the way that money moves, and this helps kind of, again, feed that narrative of higher volatility, which is, again, where traders, and portfolio managers earn their living. It's very tough to trade something that moves one tick every day and, show any sort of value add there. In terms of alpha, I think, and this is kind of where, everyone here, again, it seems like extremely bright, very quantitative background. It's an interesting question about alpha, because I think that you look at the machine learning play, everyone wants to, make the fanciest neural network, or they're trying to leverage the best alternative data. And in the equity world, I think it actually works a little bit better. I mean, there's thousands and thousands of stocks, and a lot of times you're able to sort of mitigate a lot of the risk and sort of isolate a true relationship that you're trying to model. And then, the smarter your model, you can probably do that to some degree better versus the trade-off of the complexity. In the macro markets, especially, and I think the commodities markets, there's really a true relationship to like what the actual fundamental value of the underlier should be at that point based on all the information. And you have people, going back to the idea of participants, you have people that track that. They count every barrel of oil. They look at every cargo ship that's carrying it. And so that, in one sense, is kind of the true fundamental value of the market. And then every sort of deviation from that can you contribute to expectations of the future. But because of that, I think that the market tends to be very quickly, very quick to react to things, as opposed to the equity market, which I think takes generally some time on a midterm basis to kind of digest and move higher. And then you get the kind of these exogenous shocks, right? Like, again, going back to the Apple, maybe you get an antitrust thing. And so maybe that's kind of like a jump in the price and then it kind of diffuses out. But again, you look at the commodity markets, you can get these headlines that really just move, or dramatically change the picture 10% easily, 5%, and again, I think that's one that makes that opportunity very good for traders. But in terms of the efficacy of some of the models and the back tests, I do think that it actually goes down a little bit. So we've seen, and I've been pitched a lot of machine learning products, and some of them are really interesting, and sort of like how they innovate and use the data to try and generate either volatility or price expectations. But honestly, when I look at sort of the efficacy over more baseline models, or even just very good sort of conditional probabilities with a fundamental overlay, they don't really do that much better. And it makes for a great pitch. It can make some really nice visuals, but you want to think about your money. If you invested in something, do you really want like the most complex overfit line that you don't really have a lot of generalizations for, or you want something that makes a little bit more of a fundamental sense? And that was where Quantitative was coming from, the risk premium side, where you have a prior and you don't actually want to do too many back tests, right? That idea of how many did you do is actually a very valuable thing that is something I had not actually heard before. And I think it's a really good lesson because it teaches. It's very easy to create a line that looks good, especially if you start with line making. But this process really should be to sort of tease out the relationships with either visualizations or I know they push exploratory data analysis a lot, right? Those are actually very valuable. I hated doing it when I was in school, but actually when it comes to how your money translates, it is very good. And I think especially in the macro markets, it is really a valuable thing. So again, a lot of words, and I've done a bad job. Cameron ran over the 5 minutes, but if anyone has any questions about anything, happy to sort of talk about it, either after class or in the next couple of weeks. So we have a speaker every week. So I says, Billy William Brandefine. He's a broker at PVM. He's he's in his team, one of our main execution brokers. To the point we just were talking about the alpha, and so how if you don't want to be the most complex from a quantitative standpoint, you do need that fundamental overlay, right? And if the idea is that the quant trader generally thrives on diversification, especially in the macro market, you're going to need people that know sort of that fundamental sort of market microstructure, right? Or you need that domain expert that can sort of tell you, things to maybe avoid, or if you're not exactly sure what drives, the price day over day, that they can be very helpful. In addition to providing, best quality execution. So Billy's been on working commodities for 26 years almost. And I think what's really interesting is that he's seen kind of the entire life cycle of the asset class, from when it was trading in the pit, through some of the electronification to where it is now. And that kind of insight, again, in the macro sense and in the macro markets, is extremely valuable. And as you as a trader, or quant trader, portfolio manager, whatever it is, sort of you are effectively one big machine in the sense that you're taking all these inputs and eventually, again, you got to buy or sell something. People like Billy that have been around forever and sort of know and have seen those different market environments are invaluable resources to helping you, take what is a baseline alpha and really having, the ability to, I think, adjust higher that risk-adjusted return. So anyway, that is my introduction. I'll turn it over to Billy. He's going to talk a little bit about sort of his experience, things where he sees the asset class now. Again, he's very big in oil primarily and energy. That's very germane to Houston and sort of potentially staying here and working in finance. So I think hopefully he has a lot of insights, and I'll turn it over to him.
Tough act to follow, man. Hey guys, my name is Bill Brandefine. So Max, I'm a commodities broker at PVM in New York. My primary job is doing execution of futures, options, and swaps. I also try to provide some price discovery, some market commentary, and some trade ideas to hedge funds, banks, and commercials. So I started on the floor in 1996 when the market was fully open outcry. And obviously that was the only way trades were done, is if two traders stood in the pit on steps and they stood face to face and they had a yellow across the ring, and that's how transaction right on the pad and throw it in the middle of a jig with people just data entered it like that. So the biggest change is that the market could only move as fast as you could yell or write down and get that. And I think the electronification of the market added a ton of volatility and volume, and which is the reason why I think it has changed from a primary tool that was used by commercials for hedging built on supply and demand to a financial asset class. And I think a big part of that change to an asset class was the introduction of the commodity index funds. and they came into the market in the 90s. And with the commodity fund, it just added broad exposure to the commodity markets to a ton of different investors, which added to that. And so I think that was one of the biggest changes. And obviously, another big change was in the early 2000s was China coming into the market, where they had massive economic growth, which led to infrastructure, urbanization, and construction. And through that, there was a massive demand for the raw materials, and the producers couldn't keep up with the demand that they were looking for. And I think with the influx of money from the commodity index funds, and for example, in 2006 there was 90 billion invested in from index funds in commodities, and by the end of 2007 there was 210 billion, which is a massive amount of money coming in. And that and China's thirst for these raw materials led to the commodity super cycle, which basically ran from 2002 to 2011. I don't have my notes, but sorry. So I know Max was talking about how, I'm just gonna grab my notes if you don't mind.
Go for it. So I think, and just like that's a really important point again. So you think about 60 billion, to 200 billion, whatever it is. Not only is that making the market, a higher volatility place, since that index funds tend to be long only. Again, if you think about some of those portions that are specific to the asset class, right, like deliverability, that's all notional that has to, sell the front and buy the back, or vice versa, whatever it is. And so, that kind of structural change and that kind of structural opportunity makes for, I think we're sort of like, a market that's kind of ripe for, I think, the next 5 to 10 years of really sort of seeing a lot of alpha being generated out of like a systematic space, a lot of quant space, right? You have the liquidity there to actually make your trades and have the size, but it's still, structurally, there are some themes that can really help generate long-term alpha, which again, from an equity perspective, it's kind of tough. Again, especially if you think about the benchmarks. So anyway, go ahead.
So I was talking about how the electronic trading, went from just person to person, from open outcry person to person, to where do trading electronically. You can do thousands of trades per second. And that kind of price depth and price discovery and liquidity, I think what made it made it really become a financial asset. The crude oil, the oil market has evolved. It's specifically was that once again I'm repeating myself that it added the volume and the volatility to the market, and a lot of that was directly related to algorithms and quantitative trading. Total open interest, which is the amount of open contracts, has grown by a million in the last 10 years. When I first started on the floor in 1996, the open interest in crude oil was 235,000. Now it's 2.2 million. So that's big. That. And then another big evolution in the oil market specifically was the technology that enabled us to get to the shale oil. Exposing the shale oil helped the U.S. become less dependent on foreign oil, and we've actually become, up until the pandemic, we've become a net exporter. So that obviously changes a lot of dynamics of what's going on. What was my next thing I was going to talk to you about?
There must be some basis too, right? Like, so, you have, you have the exploration of shale oil, really explode. And so that makes the different, different delivery points kind of an issue. So that leads to different types of trading, right? So whereas when Billy's saying 96, you kind of just have, WTI, and it's however many 100,000 of lots. Now, as the market has evolved to represent, to actually shift in the industry, you have derivatives that trade on basis locations, which is the difference between one point and another. And I think, that helps really, again, accentuate the idea that this market can really help evolve with the underlying industry. Because at some point, if you're a company, if you have a risk to something, you want to help, you want to hedge that in some way. You want to mitigate it. You don't want to have necessarily, this price variability. And so that's really where the commodities markets stem from. And then all the innovations at the derivative level stem from the evolving needs of that industry. Which again, I think is very specific to commodities versus, FX maybe versus equities. So.
Yeah, and I think another big change in the commodities market was going from open outcry to electronic. Open outcry, each specific commodity, like all those ones that Matt set up on the screen before, was traded only in, it's an individual pit on an individual exchange. So if you wanted to, If you wanted to trade soybeans, you had to call the soybean pit. You wanted to trade crude oil, you had to go to crude oil pit. Now, electronification has put all the market into one place.
I have a question.
Yes.
So like, how does, what is the benefit, or do you think, by me having you versus, the idea of I just do everything electronically right now?
I mean, like I said, I obviously, provide market color. I provide, price discovery, liquidity, and obviously some great trade ideas. That's why you're doing so well these days. And so there's still, there's still a human aspect in the market. There's still, obviously on the end user side with commercials and stuff, the people that actually need the oil and stuff, they numbers don't work for them. They need to be a buyer or seller or this. So I think that
the human aspect I think is important. Cash equities, for example, and G10 FX trading, it's pretty much all algorithmically driven. People execute things at the 4 p.m. fixing, or they just route it through some clearing firm. But some of the less developed macro markets really do have this component of you need someone again that knows the market. You need someone that knows the farmers, that knows the CEOs and COOs, and it really does help you kind of develop that edge. Value.
And I was saying, back when the open outcry was there, the only way a customer had any access to the market was the information disseminated at the pits. There was nothing was on Bloomberg. There was nothing there for everyone to see. There was and obviously the market became very transparent with all the information and technology. Another point I was in sorry guys. Outside of a couple best man speeches, I haven't done much public speaking. If it wasn't blatantly obvious.
What are some of the opportunities in the oil market here from like a trading perspective?
Well, I was nothing else. I think the quantitative trading. I think it can really take advantage of the inefficiencies in the commodities market. Commodities market is still being very, very young compared to equities, and I think the inefficiencies are really human emotions. Fear and greed are really what a big thing that changes it. And obviously, quantitative trading it's numbers. It's not based on on someone's perception of what's going to happen, and that's I think that can be definitely taken advantage of with the quantitative trading.
Do the big producers, who are they? What are the kind of the roles they're looking for to hire from?
Well, I think in the last couple of years we've seen a big change in they're looking for people with physics and math degrees opposed to people with basic finance and knowledge of the physical markets. I think obviously there's still some specialists that need that kind of that have to have that kind of specialty, but it's the market's changing. It's no longer just a tool for hedging, and of supply and demand. It's a completely financial asset, and I think that change has changed the whole market and changed the kind of participants that they're looking for now. I don't think like a Shell and like a Shell or a BP. They have physical guys. They need guys to bring the young people to bring the technology and the understanding of this technology now that help them move further into the digital age, so to speak.
I think it's also interesting that a lot, and so I've been interviewed as well as interviewed some people that have come from this role, is that a lot of the people that own the physical goods, so you think the people that own the barrels of oil, or people that own the bushels of corn, they are actually looking to hire people, like yourselves, that have the quantitative background to help transform the information that they solely have, right? Like they know where physical good is. So that is, at the end of the day, going to be a very big determinant of where price goes and how to make money out of it. And it's not, it's in some ways their own proprietary information. So if you think like a Trafigura, for example, they own however many thousands, hundreds of millions of barrels of oil, and they know where it is in the world, and they have the information of how that physical inventory is being moved. How can they turn that information into a systematic signal of how calendar structure is going to move or how implied vol is going to move? And that's a real role, and that's one that I think kind of, whereas sell-side banks hiring people like myself to do systematic trading development, that was the rage 5 years ago. The buy side and the trade houses especially trying to look to hire people to help develop their own systematic framework, that's really like where the money, and those guys pay really, really well. Like crazy well. And mostly in like either cash or private placement stock, as opposed to stock in a bank. So that is really one of the things that if this sounds anything interesting to you, that I would say that's one of the places to really look. And we talked about internships, right? You know, in the first week, and I know that those interviews, the first round are starting to go on. But if you still have time or you're still thinking, you know, I'm happy to get a couple names of places that are here. That could be really interesting places that maybe you guys would like to spend, you know, your first step in that financial career. Anyway.
But, so I guess we're talking about the opportunities.
I guess, does anyone have any questions for Billy? I mean, you know, we only have about.
I'm more, you know, I'd love for you guys to ask me some questions. I'd love to tell you about the markets, to tell you about that. I mean, I fortunately, yes,
Who are
sir.
some of the greatest traders that you ever were on the floor?
Not on the floor. This guy's one of the greatest traders I've worked in 25. I'm not just saying that because he's my client. But I mean, the greatest traders are the guys that had, you know, could take a position on and ride it and be wrong and hold it till they're right. And there was traders that could stand there. And most of these guys were trading their own money. I mean, you know, they were providing liquidity for this was way before that, obviously the hedge fund money and all that came in, but they were providing liquidity for these major corporations that need to get out. And someone, you know, would take on 1,000, they would buy 1,000 contracts from Shell, and you have to hold it and, you know, and wait till the price is moving. And that's the kind of trading. Like traders like that are the greatest traders I saw. The ones that could stand there and trade their own money and be able to out-trade or outlast, like, you know, some of the biggest companies in the world, these Fortune 500 companies. And, you know, a guy from middle Long Island stand in the pit and stand there and you know, and squeeze them and make them either pay up or sell lower or, you know, or force their hand. You know, and this guy's just using his own money to back him, not, you know, not the billions of dollars that these major companies have. Any other questions, anyone?
What's the largest position you've ever had?
Me, I know, I've only been a broker. I've only dealt with, you know, a client. I'm basically the liaison between the client and the market. So, yeah. So yeah, that's actually good. That picture was in the newspaper when the financial crisis was happening, and I just got caught a look at picture of me. And on the bottom of the headline, the caption was, "Two phones weren't enough for a commodities trader as oil hit $78," and that was on the rise, right? You know, right 2007, the days before the oil went up to $140, and right before it all, you know, kind of, you know, so when the financial crisis started countrywide and the mortgage, and that was right at that point was when oil hit $78, and that was the highest it ever traded.
Okay. So we only have 5 minutes left. So
Sorry, guys. I'll
pause it there. Thank you, Billy. As always.
Thank you.
So I think actually, you know, the idea of like who is the best trader, you ever saw the idea of trading your own money. It's an interesting idea because, you know, now everyone has a boss, and so, you know, risk limits are obviously a very important thing. And so, you know, especially in the macro markets, you have to have the idea and have the idea being correct and well formulated, but then you also have to have the timing a lot more apt, right? Because you can definitely be completely right about the market, and for whatever reason or rationality, it's going to go the other way. And, you know, being able to manage that and sort of, like I said, stick through the losses is really, I think, at the end of the day, what, you know, in my short tenure as well, I've seen the people that succeed versus, you know, people that are extremely bright but maybe end up doing something else just because they don't really like that portion of it. And so that's very apt, again, timing-wise, for what we'll talk about next week. So we're kind of going to talk about commodities this week, and we're going to talk about FX in 2 weeks. So we're going to intersperse it with kind of like this idea of buy-side week. Because I think, again, you know, not everyone wants to go work for a bank, and I get that. I won't be offended. But, you know, these guys are effectively two you know, colleagues and mentors of mine that now work on the buy side. And one of them, McCool, actually does this. He trades his own money, which is I would say that at the farthest end of the spectrum in terms of like the fear aspect and being able to stand through losses, because every red day, that is his direct income and his family's income and whatever, you know, whatever he uses it for. And so I think he can give actually some very interesting insight to that portion. And, you know, he's a different period of life versus Thompson, who works at, like I said, at Gunvor. He's senior portfolio manager there. You know, he started actually in the commodity index. Well, actually, they both started in the commodity index world, so they can, you know, talk about the sell side and the transition maybe, if that's interesting to you guys. But, you know, so these guys effectively do it. You know, whereas I have, you know, both. I do have a risk role, right, and I do need to help generate value. But we have a lot of franchise work. We have a lot of things to do from a regulatory standpoint and everything that goes into working in a bank. These guys, you know, their job is to effectively come into the everyday and either, you know, come out, think about ideas, look to implement ideas, and then just monitor the effectively the performance. And that's kind of a scary thing, you know. When we talked about where's a good first step, right? You know, the career is one big path. the banks, do provide this opportunity of like, how do you monetize flow just to at least a proportion of your risk, right? And when you do that, you have an anchor. You have a price that you got into it at. You help service a client need. Everyone wins. Everyone's happy, and you're able to sort of navigate around that risk. And at its simplest form, you look at where the bid and the ask are for whatever asset, let's say, and you add 5 cents on either side, and maybe you get done, and then you can punch out of it, and you've made money. This is a very different sort of problem and opportunity set where you kind of have a blank set or slate, right? You don't have a reference price. There's no flow to manage. You're not necessarily getting the information of that flow, and you have to somehow be able to generate alpha in a sustainable way. So I think it'll be really interesting. Again, these are everyone wants to work at a hedge fund. These guys do, and they can sort of tell you, what portions are true of what you think, and hopefully give some insight to maybe the parts that you didn't really think about. And this is something that I think would have been extremely valuable to me when I was graduating from the MSTAT program, because again, you hear a lot about like what you think working at a fund is and like what your life will be if you work on the buy side. And I think it's definitely changed since 2008 for sure. Called like the heydays of finance pre-2008. So they'll be here next week. Well, McCool is in Houston, so he'll be here in person, and Thompson will zoom in from either New York or Geneva. And like I said, I'm here these 2 weeks, and I can be available. I'm staying 3 blocks to sort of towards Holcomb, and I'm working in Greenway right now. So anyone ever wants to meet, or you have questions, happy to come by Rice or meet wherever you want, and can make myself available to you guys while I'm here for this period. If you have any questions, you want to go over things. But other than that, turn it over to Dr. Doleman.
All right, let's thank
bring it
our
out.
speakers. Answer has any comments. He's our instructor for this class.
Phenomenally, instructor. First of all, just thank you. This is
Thank
so hugely valuable, and I hope everyone in the room recognizes how valuable this is. And due time, you can come back and do this as well.
The real dream.
But again, thank you for the opportunity to meet with everyone. I wonder. So some of these internships, we do have a mailing list if you want to send them out, but if you prefer to know people, the people in the class, that's fine as well.
Yeah, for sure. Again, if you have specific interest, to the extent that I can answer it, I'm happy to help point you to maybe this company or this fund would be better, because I think that even though one of the less sort of value portions is that even though everything I would say is getting better, culturally you really want to be somewhere that's a good fit, especially in a place where you're not really generating a value or a product. I think personalities can definitely clash in finance, and you want to make sure that there's somewhere that both supports you professionally from a risk culture, and as well as your lifestyles or whatever it is that interests you, that you can have a life away from work. And I think that's become very evident to me as I've become more of a manager, but also through the last 2 years. So yeah, if you guys have any specific interests, and it's not even commodities, BFX. You want to work at a credit fund, if I don't know, I'm happy to try and source people that do, and I'm happy to do it on a one-on-one basis. It's not a problem.
It's fantastic. I will just take a moment we do have the time series conference Friday and Saturday. It's virtual, and there's a couple of machine learning type stuff, but much more boring than this actually. But if anybody in the class is interested in jumping in on that, just you can register. Take from it what you're interested in. You don't have to attend the whole thing.
Can they count as one of their seminars?
You could count as one of their seminars.
Of course, yes.
So there's some. It's mostly equities based, as pointed out. That's where all the data is for us to get this very easily. I'm very much interested in a commodities focus. It's just harder to get the data.
It is, yeah, for sure.
It's much harder.
Well, we don't want to keep you guys after. Maybe if you wanted to hang out for a minute or two, we do have a faculty meeting after this. I'm sorry to report, so you don't have that much time, but you can always contact Max via the email.
Yeah,
And-
hit me up. Always available.
And Billy has a very small web footprint, so if you need to get in touch with him, you can do that through either Max or myself, I'll get in touch with Max and he can get in touch with him. But thank you so much.
Thanks for having me.
I was a Jack Carl customer around the turn of the century until EDF and Mann went away.
That's what my big movement, my career was getting hired by EDF Mann and then leaving the trading floor in 2007 when we saw the kind of the writing on the wall, and that's where I kind of built my business, was at EDF Mann.
Interesting. Yeah, I always like that.
So how many phones do you need?
The two, yeah, sometimes you have three, one in each hand, one in your pocket, but now everything's basically really done
Just need chat.
Yeah, Bloomberg chat now.
I like the taping those.
Oh, you had to
That
keep
was
on your
awesome.
shows, listen, and you had to write the orders, like that, that's how it did, and and write that, you had to pass the order to the trader, like verbally, or give him a hand signal. It was organized chaos, but somehow it did work. Somehow it was efficient, and at the time it was efficient.
There's a song I've been meaning to write for a long time, and it's called Gladys Night in the Pits. Okay, thank you, guys. I'm gonna let y'all head out. I do have one phone here. I don't know
Oh,
whose
this
it
is
is.
my lack of timing. But yes, I'll come back, be back next week, with McCool, stop by, say hello
Of
to
course,
you guys.
maybe we can get together.
Yeah.
At your place. I'd like to see your office.
Yeah, the Greenway floor is not as nice as the Bryant Park one in New York, but
Well, if you have time, I can make time to stop by.
yeah, for sure. I will be